Hello and welcome to today's virtual coffee talk webinar. My name is Margaret and I will be your web host for today. We have a few housekeeping announcements and then I will introduce our speakers. As a reminder, in order to earn CPE credit for today's session, please stay connected to the webcast for the entire program and participate by responding to at least 3 of the 4 interactive poll questions. Second, there will be a course evaluation which will open in a new window upon exiting the webcast at the end of the broadcast. And with that, I'll introduce our speakers. Kevin M. Jacobs is a managing director with Alvarez & Marsal Tax in Washington, D.C., and the National Tax Office practice leader. He brings more than 15 years of experience in tax matters in both the public and private sector. Mark Alms is a managing director with Alvarez & Marsal Tax in New York. He focuses on the integration of transfer pricing policies following a merger or other business restructuring event, which may include global transfer pricing planning and policy development relating to the development and exploitation of intellectual property rights. Antonio Macias Valdez is a senior director with Alvarez & Marsal Tax LLC in Miami. He has over 24 years of experience in transfer pricing at leading global consulting and law firms. Andre Rosa is a director with Alvarez & Marsal's Tax and Labor Group in Sao Paulo. He has over 13 years of experience in providing tax advisory on M&A transactions and assisting both local and foreign entities, including corporations, private equity funds, sovereign wealth funds, and pension funds. Finally, as always, Kevin DeYoung is a lead product manager with Wolters Kluwer Tax and Accounting. He will be showing us today how to find additional answers and resources using CCH Answer Connect. Thank you. And Kevin, take it away.
Thanks, Margaret. And thanks everyone for taking the time to talk to us today about the new Brazilian transfer pricing rules and what we are anticipating on the horizon. Why don't we jump right in and talk about the agenda we're planning to talk about, which is we're planning to highlight and what do we currently see as the overview of Brazilian tax and transfer pricing reform. Obviously, transfer pricing is something that all international experts, any multinational company has to think about, and there's been a big focus, particularly as a result of the US foreign tax credit rules on Brazil, and so now we're starting to see some of the reform of impacting what's going on in Brazil. We'll talk about the new regulations and the implications it has on the US multinationals, action points, and obviously best practices, so that way hopefully after this panel you'll have some takeaways of things to also consider. Just to note, our contact information is in the back, and so if you have particular questions for your particular circumstance, we won't be able to answer that during this presentation. Feel free to reach out to us afterwards. But we're hoping to be able to go through a cost sharing example as well as opportunities and planning. And of course, at the end, as mentioned, Kevin DeYoung will show us Answer Connect. We're going to jump right into the first polling question, which is, have you started to address compliance with the new Brazilian transfer pricing regulations? Yes, we're ahead of the game. No, but we've started making a game plan to do so, or it doesn't impact the company that I work for. Again, just a friendly reminder, you do need to answer the polling questions in order to get your CPE certificate. Mark, while they're answering the question, why don't we start going over an overview of the Brazilian transfer pricing regs?
Yeah, thank you, Kevin. And it's a pleasure to be here on this wonderful coffee talk. Look, this is a pretty exciting topic in the world of transfer pricing. Yeah, and I think even that our initial polling question here goes exactly to this point, right? You know, for the longest time, Brazil has been an outlier in the world of transfer pricing. You know, in that it did not follow OECD, it did not follow the arm's length principle, which, as you know, all of us working in this space know that the arm's length principle is the bedrock foundation, really, of all the work that we do. And so when you have an economy the size of Brazil, yeah, that's kind of out there on its own and is not following these international standards. It presents a lot of uncertainty for companies. It has historically presented, you know, odd situations for advisors as well. You know, you're trying to establish global policies, and then you have to develop some carve-out exceptions for Brazil. Yeah, and again, as one of the larger economies, you know, not just in the world, but certainly a leading economy then in Latin America and often a hub for certain operations in Latin America. And that presents some real challenges for businesses to follow. So again, this is a really exciting time for us, right? We've really been waiting for this, I think, for a number of years. I think probably many of us, even when the news was coming out, were kind of waiting in disbelief, right? Is it really happening? What's going to come up now, right? What last minute hiccups will arise and perhaps derail this? But here we are, and we're actually, in a place of looking to implement. And as you've laid out, Kevin, what we're really kind of hoping to go through, I've got really my core specialist colleagues here, Antonio on Latin America and Andre specific to Brazil. And we want to kind of lay out a little bit of a deeper overview of what these regulations mean or what the new guidance will mean. And then going over through some practical examples, right, of kind of how this will actually translate into a company's transfer pricing policy globally. So with that, Andre, I think we're going to transition here and do that little deeper dive into the newest legislation here.
Absolutely. Thank you, Mark. Hi, everyone. Glad to be here, and thank you for joining. As correctly pointed out by Mark, this is a very interesting... Não tá me ouvindo? Can't you guys hear me? Yep. Yes. Okay. As correctly pointed out, this is a very interesting time in Brazil when it comes to tax matters. The National Congress and the government are finally aligned when it comes to changing tax legislation in Brazil, and that applies not only to transfer pricing but also to other major tax aspects in Brazil. For example, we have VAT tax reform going on that aims at simplifying the overall VAT system in Brazil, which is composed by 6 different taxes, and there are different levels of taxation between the states, municipalities, and federal government. And Brazil is, again, with this mood of changing things, simplifying things, and this also applies to transfer pricing. The previous set of transfer pricing rules in Brazil were in place since 1996. And as pointed out by Mark, it was a very unique system. You only saw it in Brazil. It had predefined rules, fixed margins, and the taxpayer normally had the ability to elect the method it wanted. And it was more a compliance work. Taxpayers did not have to worry too much about transfer pricing. It was normally a matter of reflecting the transfer pricing calculations in the income tax return the year after the fiscal end. So it was sort of a more straightforward and check the box thing in Brazil. Late last year, the previous government in Brazil issued a provisional measure which aimed at aligning transfer pricing rules in Brazil with OECD. This has been a matter that has been discussed in Brazil for many, many years. OECD has been visiting Brazil for the last 3-4 years to discuss specifically about transfer pricing and try to convince the government to change its rules, because it creates lots of discrepancies when multinationals have to define their global policies in terms of transfer pricing. Because Brazil had this unique system, normally there was a mismatch between transfer pricing adjustments in Brazil and the rest of the world. And in many cases, Brazilian companies, part of multinational groups, have been kept apart of global transfer pricing policies simply because it was just easier to assume that a transfer pricing adjustment abroad would be required because of this unique set of rules. And when I say unique, it ended up created a very unequal situation. In some cases, the law was more beneficial to the taxpayer, in others less beneficial. And by adopting new rules, which will become effective as of 2024 or optionally as of 2023 for the taxpayer election, the idea is that we'll have a more fair set of rules in Brazil when it comes to transfer pricing. Okay, now Brazil is fully aligned with OECD. Maybe we have one of the more complex and complete set of rules when it comes to transfer pricing. The previous government and OECD experts and the National Congress have done a good job in terms of reflecting all OECD guidelines into our legislation. So I really strongly recommend you all here that have a subsidiary in Brazil or that operate down here to pay close attention to transfer pricing matters, because one, that both companies and tax specialists, lawyers, the entire market is not ready to absorb all the OECD guidelines from a practical standpoint. Many of us know about the formal aspects, they have studied abroad, but most of us do not have practical experience when it comes to applying OECD rules. And that's how we can connect with you. Antonio here has a lot of experience when it comes to applying OECD rules in South American countries. He has done it many times, and we are having a really good success with applying new transfer pricing rules to clients.
It is interesting, Mark, when you look at this slide, right, in the sense of there are these winners and losers when you say, like, okay, well, under the former rules, right, the taxpayers got to pick exactly, what their preferred method is, and now under the new rules, it's like, haha, you're stuck. But at the same point, you have more wiggle room of talking to the tax authorities. So it's not just a basket, and really it's a matter, as I think highlighted, and it's going to be highlighted on this presentation, that everyone really needs to revisit what they were doing for transfer pricing, because it may not be the methodology you were using is now going to be approved, but also it may actually be, because of the OECD standards and so forth, the application and the rules are totally different, and so you might actually be wanting a different answer.
And of course, Kevin, right, the trick for transfer pricing in general is that there is no one answer fits all. Right, every company is different. Whether you're Brazilian headquartered, you may be thinking about things very differently than if you're a U.S. headquartered company, operating a subsidiary in Brazil. And so I think exactly right. Kind of thinking about those winners and losers, it's always going to vary, and kind of what those opportunities are will be different for each company. Yeah, and so maybe picking up on that, Kevin, here real quick. Part of what we do see, is that what these rules will start to afford, though, right, is just having that little extra certainty around, or just getting a better applicability of some of the rules, right, that we're aware of. Again, following arm's length principles means that things will follow in line. Or thinking about foreign tax credits. And obviously there's still some uncertainty about exactly what those final regs will look like on the FTC side. And that's for another time. But in principle, right, when we're having a country that's following arm's length principles will make it easier to, or just kind of more reliable, right, on how the rules are going to fit and apply to the Brazilian circumstances. Same thing as we've been talking about, right, that ability to follow these common standards, guidelines, means that, or the expectation is at least, that it will be easier, right, for companies to kind of manage their global tax policies, being able to at least work to policies that, to the extent that they can, right, will not work themselves into double tax. Whereas historically, that can be pretty tricky when you're kind of having to apply your global transfer pricing under 482 or OECD, and then doing something different for Brazil. You just kind of get stuck every now and then, right, with a certain level of profit that's just going to be double taxed, and you just couldn't really do much about it. And certainly just the broader consistency, right, and being able to apply that globally, which is also important when we think about other aspects like CBC, and those other elements where we have to just do informational reporting. And it was always that outlier, right? Hey, what are we doing for Brazil? We're doing it different. And you always kind of put it to the side. When we look at some of the issues that are still going to be, that still need to be resolved, for me, certainly one of the big items is, we still don't have a tax treaty, of course, right? Just having the new legislation in Brazil doesn't magically make a double tax treaty appear for us. That might be nice. I think, those of us who follow the treaty world, can also appreciate that it will even though it's being pushed, this is going to be a long time in all likelihood before we actually get a double tax treaty in place. But hopefully these kind of steps, right, sort of move us in that direction. And even if without a treaty, just at least having the common set of principles will make it easier to work through between the tax authorities. And again, just trying to plan in a way that we can avoid some of those issues. We're still going to have some of the other fun taxes, if you will, sort of specific to Brazil, some of the local indirect and the state and city taxes. Again, this kind of, I see this very similar, though, of course, to doing business in the U.S. as well, right? Where you're going to have to deal with the different state level taxing authorities, et cetera. And indirect VAT if you're in Europe, or so. Yes, we do have to plan around this for Brazil, right? But in my mind, at least, this isn't so of a distinguishing factor compared to the rest of the world now, right? Once we get set on this basis. So, what we do want to do now is sort of a transition in a little bit more deeply. Antonio, I think you're going to take us through here a little bit more on some of the specific changes, right? And some of the specific attributes here in Brazil.
Thanks, Mark. Thanks, everybody. This topic of OECD transfer pricing in Brazil has been in my mind since I started transfer pricing in 1998 in Mexico. Since then, I have been always hearing Brazil is going to be OECD, Brazil is going to be OECD, and now 25 years later, with more white hair, now it's coming to reality. So this has been as the tale of the wolf that it has always was coming. So when we look specifically on Brazil legislation, which is a proposed regulation as now, what we see is one of the most comprehensive and more complete transfer pricing regulations in the world. And why I can state that, and mainly is because this is one of the regulations that has been written post-BEPS. And what has been incorporated in these regulations are all the thought process that had been put in place and has been discussed in some way. It is put into this legislation. This legislation has 81 articles, around 45 pages, which is not normal, at least from a Latin American perspective, to see that amount of articles. And more than the robust numbers of articles, there are specific articles that put the pace and the expectations that the tax authorities are expecting to have when they are implementing the OECD. So there was like a bargaining. Whoa! Now we say okay to the OECD, but also then we will have rules which are kind of tight and with a lot of detail to put into. One of those is, I will just highlight certain articles that for me are important. One is the article number 9. It talks about the design of a control transaction. Usually in the transfer pricing analysis, we were always focusing on the comparability analysis. But in here, it tells you that directly you have to look at the design of a transaction, that you have to pay attention that if a third party would have entered into that specific transaction. So it put an important layer on that. Another important article is the realistic available options. That also means that if there's another transaction or another way of dealing into the pricing of that should have been taken into consideration. This is an article that opens the door to the recharacterization of the transaction. That for Brazilian purposes is very important because we know how it's treated the transactions, and knowing that there's a lack of tax treaty between the US and Brazil, this might come into the ability of the tax authority to use this article as restructuring the transactions and characterizes as how they expected to do it. So it has to be carefully looked. Also, it includes the contractual terms, and also telling, it's not just the contractual terms, it's what is really happening on the facts and circumstances. It's a legislation that is based on the facts and circumstances of the transaction, which was not in the case in the past. Also, the risk, as we have been following, now you have to support the risk, and it's not just that it's in the agreement, it has to execute the management of the risk. That puts a lot of tension into that. Also, business strategy. This is an example in which if you have a strategy, you have to implement it previously, and you have to state that. And that's very important when we are dealing in marketing activities related to the intangible property. One of the ones which I put more attention is business restructuring. And this is an article in the case that you change your business profile or your business activity or the risk related to the transaction, the regulations allows them to have a remuneration for that. Usually this is very important when you are switching from a full-fledged distributor to a limited risk distributor, how it's written in the regulations, the tax authority has the ability to put a price on that, to have a charge for that. Another part which I'd say it's important on the documentation is the tested party. Let's say that in the documentation you don't include the specific functions, risks, and assets of both parties. If you don't put that, the tax authority will assume that the risk, intangibles, and functions that are not put in the other tested party will be on the Brazilian side. So if you have a floppy documentation, it can lead you towards that saying that the owner of the IP, the risk, assuming the risk and the function is Brazil, and therefore a more profitability is expected. The other one, a little technical, range of comparables. It says if you have a wide range, now it has to be limited on a 20% deviation. So you cannot have those big interquartile ranges. You have to be limited to the 20%. And the last one is that you have to apply a country risk adjustment if you are using comparables that are not Brazilian comparables. So in a nutshell, this is kind of setting the tones of what we are expecting on the regulations. And a lot of these items have to be taken action previous the intercompany transaction is executed, or when it's executed, or the transfer pricing policy. It cannot leave you at the end when we're doing the documentation.
And basically, Antonio, these will all be important to take into consideration when you're sort of doing an assessment of the arrangements, right, and how we're going to kind of think about this going forward. And I think we have a polling question here up first, so I might just pause for a moment, and then we'll get into that sort of roadmap for assessment.
Yep. So polling question 2 is, do you plan to make changes to your transfer pricing process to align with the new Brazilian transfer pricing regulations? Yes, no, or we've already implemented changes in the tax transfer pricing team. And you know, while they're answering the question, just to note, obviously, once you remove the country specific and you focus to OECD guidance, it sort of takes some of the power away. Obviously, each country has the ability to adopt it in their own fashion, but it takes some of the power away, and it gives the ebbs and flows, and we're seeing that in OECD. So for example, Pillar 2 and what's happening in Pillar 2, and you always have to watch what's happening at the OECD front. And so it'll be interesting to see how the flexibility of the regulations will handle the potential widespread changes that might be coming as the OECD keeps thinking about all these processes. But while they're continuing to answer this, Mark, I guess, do we want to turn our attention to some of the transfer pricing roadmap?
Yeah, that'd be great. Antonio and Andre, as we're sort of thinking about this, right, this is really kind of the nuts and bolts of what companies are going to be looking at here. And I think you want to sort of maybe take us through a little bit, kind of an approach, if you will, to sort of thinking about all these steps that Antonio was just talking about, and of course, just taking us through the process here.
Yeah, definitely. This is a process that when we look at how we adapt the global transfer pricing policy of the multinational companies, U.S. multinational companies, how we adapt it to Brazil, we have first to think that this is a process that is based more on the organization, and it's more a structural process rather than a tax exercise, as Andre was saying. What we have to see, it's a supply chain type of analysis rather than just that part. And when we first do the steps on how we address this, the first thing is to have a first initial transfer pricing assessment. This allows to know how they are applying their transfer pricing policies, if they have a specific change on that, how the actual transfer pricing policies are, how successful it could be to be compliant with the OECD, if they have to have any changes in adjustments. That's something that is important to have. Once we have that clear picture, then we have to move very quickly to make the decision if these regulations will be enforced, or we will be electing to enforce those regulations for 2023 fiscal year. So there's the ability of the taxpayer to elect at certain point, and right now I don't know if it's already the deadline on when you have to put that. At least the only thing I have been seen is the annex that it's in the proposed regulations, but no more than that.
That's all we have so far, Antonio. The tax authorities opened a public consultation to hear from taxpayers their concerns and occasionally extend this election deadline from September 30 to November. But so far, no news. So until this moment, the taxpayers must elect by September 30 to adopt or not new rules. So we have a very short window of opportunity here if taxpayers still want to elect to anticipate new rules for this year.
And as we was saying at the beginning of the presentation, there will be winners and losers when you move into these ones, and you have to be pretty sure in which position you are, such in a way that you decide to implement it prior or after 2023. So it's important. My only advice in that, if you are changing into the legislation, you have to be sure that your function, risk, and asset, and that all the intercompany agreements are put in place, because any change that you do on those could carry out that business restructuring. So it's very important, if you take the decision to say, yes, I want to follow up, that you are really prepared and that you have already everything in place from an operational perspective to go into that, or no? Then, of course, then we move into what for me is one of the most important things, which is the definition of the transfer pricing policy, including also the high-level operational TP assessment. This is when you have your global transfer pricing department of the multinational company, and you have your local tax person that is in charge of the compliance. There's actually, you have to understand what is the communication and how they interact, because the more better communication it has with your counterpart in Brazil, it will be better the application of that. And once you have done that, then you define your transfer pricing policy. That's the time in which you said that transfer pricing policy is according to the arm's length principle, and you have to know which are the changes that you have to look, if there's any changes that you have to do, which are the agreements that you have to put in place, such in a way that once you have that, then you can document your transfer pricing policy. This is like pre-doing your transfer pricing documentation, which you have everything aligned, everything is put together such in a way that you are sure that you will be complying with the transfer pricing policy based on a methodology that is OECD. And once you have that, then you will be sure that you implement correctly that, because there's a lot of cases which you have the correct transfer pricing policy, the model, and not necessarily the implementation is done correctly. It's not only setting the correct pricing, but also acting as how you have stated in your function and analysis. And lastly, you have your transfer pricing compliance documentation that will be 1 year after you have concluded the tax year. That's where you will be presenting the documentation. There still is not a date in which you will be submitting that. My expectation will be something on June after the closing of the tax year, but right now there's nothing in place. So this is kind of the roadmap that you have to follow into successfully adapting to the transfer pricing regulations in Brazil.
You know, and Andre, when I kind of think about this, you know, to me, one of the important parts is that even though, you know, many of us, right, are very familiar with the principles under OECD, right, the methods, the approaches, all these things, it's not necessarily an easy switch to just say, hey, great, right, I know all this, let me go ahead and apply it to 23 already, because I know how this works, right? I can just do this.
Yeah, and that's a very good point, Mark. And companies definitely need to prepare in Brazil, because tax authorities and the government, they are eager to get more tax revenue. So if we do things wrong, or if we do not prepare properly, it's very likely that tax authorities will raise questionings and assessments in the future, and taxpayers will be in a bad position or in a risky position.
And so I think, Andre, just looking at the general timeline here, we can just spend a moment on this, but again, I think the idea here is that it's kind of following the typical sort of process, right, from a documentation and analysis kind of standpoint, right? And this is kind of really taking all the way forward. To me, one of the things here, by the way, again, just kind of skipping to the last point about anticipating controversy and audit experience, and you already touched on this early on. It's going to take a little bit of time for the Brazilian tax authority to get up to speed on this. I think when we spoke a little bit earlier in the week, you mentioned there might be I think the number was about 6,000 some odd inspectors in Brazil, of that maybe 100 or so are conversant in transfer pricing. It's going to be a challenge to get everybody up to speed and getting this kind of enforcement in place.
Yeah, we definitely need a cultural change in Brazil. Taxpayers and tax authorities as well need to understand that now we have to plan ahead and not just to wait until the fiscal year ends to start reviewing and adjusting transfer pricing. So we definitely need to be ahead of the game and start reviewing everything at forehand in order to properly prepare and do not have any negative tax consequences as a result of new transfer pricing rules in Brazil.
Well, it's going to be interesting. Sorry, Antonio. That just to note, like in the U.S., a lot of people just focus on, oh, it's not just the IRS, right? It's also, for the large companies, the financial statement auditors. And so it's going to be those people that are going to actually probably enforce even more so before they get to, the Brazilian tax authorities. And when you have a new regime, at least my experience, when you have a new regime and you have financial statement auditors from different companies, they may be taking different approaches. So it's not, and that's only puts like the stress on how important it is to have the proper documentation and to say every step of the way, this is what we did, because the controversy isn't necessarily controversy with the Brazilian tax authorities. It might be internally of okay, what does your auditor say? How are we going to make sure that they're comfortable with what you're doing? But Antonio, I apologize, I cut you off.
No. It's something in that line. And one of the things when I look at this slide, I put a significant stress, in the implementation of the transfer pricing policy. The documentation, it goes afterwards. But whatever you don't do at the time when you are implementing your transaction, that could have a significant effect on the way that you are documenting that. Because if you don't have that intercompany agreement when the transaction is being put in place, you will be in a weak position to support certain parts. If you don't have a strategy on the marketing, on how you will split the expenses related to the marketing, you could be in a position at the end that you could be having the legal ownership of the IP. So those things are, for me, the most important thing is in the implementation. And knowing that this is the first time in which you will show the picture of your company to the tax authority related to your function, risk, and assets, it's very important that that picture that you are putting is consistent to what is happening in the reality. Because any change that you have on that, it could have a consequence. You can be in that business restructuring change. So it's so important, the part of implementing this prior the regulations are enforced. So for me, that window between today and December is the most important window that the taxpayers have to take into consideration, because that's where you can do the changes. That's where there will not be any consequences of doing that change, because the rules are not enforced at that time. And that's where you have to put a lot of stress.
And an important part of that as well, right, will be on just the actual system side, and making sure to keep that in mind and leaving time that this is actually a change, and how that's going to be flowing through the accounting systems. And because again, companies have been operating under a certain model now for years, decades. Mm-hmm. Anytime you make change, any kind of upheaval, right, to an ERP system, tends to require a little bit of time and effort.
Yeah, for me, it's a behavioral change that has to happen. And that's one
Maybe
of the
just briefly here on Antonio and Andre on kind of the components here, and I know we'll probably talk about these as well as we look at a couple of case examples and kind of draw out some of these areas a little bit more specifically. But
yeah,
so just a quick overview.
Yeah, so in this one is this first analysis that have to put in place. In here, there are some of the components that we stress when we're doing this analysis. One is the alignment to the business model, how you align to your global transfer pricing system. Are you aligned or not? Usually we look at the master file and we see what are the actual transactions in the local entity. One of the most important things that we put a lot of stress is in the IP, in the intellectual property. Why? Because in the past, it didn't matter for Brazilian regulations if you own or not own the IP. So sometimes what has happened because of that lack of importance, at least from a Brazilian side, you could be in a position in which you might be being the economic owner of that IP. So we put a lot of stress to identify in a very laser way who has the legal and economic ownership of the IP. Also, we put stress on the risk. Why? Because in the past, it didn't matter what risk if you were taking or not the risk for the remuneration of your entity. Now it's a significant matter, so we put that stress. And finally, we do what we transfer pricing people know, which is our benchmark analysis, the methodology that we are setting. We are defining the comparables. Remember that in Brazil, you have now a significant database of private companies. So you have 3,000 companies that could be potential comparables. You have to look at those. And then, if not, as mentioned, you have to do a country risk adjustment that, by the way, how it's written, it will only increase the profitability of the Brazilian entity if you are applying that country risk. So you have to do this. This is a very quick, focused analysis that has to be taken into consideration, because once you do that, then you take the correct action items to define your policy and then to implement that.
And Andre, just thinking here quickly, about the comparability side and the benchmarking side, is there already sort of any early guidance, any early thought on whether that's going to be a real focus on local comparables versus more of a regional, or looking to sort of establish North American markets or something?
This is still a gray area, Mark. We're not sure how tax authorities will behave when it comes to comparables, but based on our experience and based on other benchmark analysis made in the past, tax authorities always prefer to stay close to the Brazilian market. So the closer the comparable is, in a better position the taxpayer would be to support its position.
Perfect. Kevin, I think we have a next polling question up, and then we can get Andre into one of our case examples here.
Great. So here's polling question 3. Do you have management cost allocation or cost sharing in place with your Brazilian entity? Yes, no, or we haven't even thought about it yet. So I guess, Andre, while they're thinking about it, if you want to start discussing some of the facts associated with the case study.
Absolutely. Yeah, before we dig into the specific details for transfer pricing, just want to set some general facts here. Brazil does not have a specific legislation for cost sharing, at least before those new transfer pricing rules came in force. And taxpayers, of course, based on international practice, they have always tried to set cost sharing arrangements and treat cost sharing arrangements as reimbursements of expenses versus imports of services. This is normally not an issue for many countries, but in Brazil it is, because imports of services are subject to a very high tax burden that, by summing 5 different taxes, can go up to 45% or even higher. So tax authorities, they pay very good attention on top of cost sharing arrangements. They use all the efforts they have to try decharacterizing cost sharings as neutral from a tax standpoint and try imposing all these tax burden applicable to imports of services. And because of that, now that cost sharing has been put into the wide of transactions applicable for transfer pricing purposes, taxpayers definitely need to pay a very good attention to cost sharing, because if they have a cost-sharing arrangement in place that is neutral from a tax perspective when it comes to the cross-border remittance, depending on the information you provide to tax authorities when running the transfer pricing exercise, the company may be put on a risky position, and the cost sharing may not only result in a transfer pricing adjustment in Brazil, but also to the imposition of the high tax burden that I mentioned.
And of course, one of the important things here, Andre, right, just briefly just to sort of confirm this for the benefit of the U.S. side audience, right? Because I think when I hear cost sharing, right, as a U.S. practitioner, I'm always automatically thinking about this in the context of IP development, specifically in a cost sharing arrangement, right, a qualified cost sharing. And of course, here in the Brazilian context, it's different, and that has a very specific reason, right? I mean, it's with intent that we call it a cost sharing for Brazilian purposes here for these kind of management activities or other kind of corporate activities, right?
No, you're absolutely right, Mark. In Brazil, again, we do not have any legislation addressing what is considered to be a cost sharing or not. So we have to rely on the doctrine or on the international practice. And from a practical perspective, tax authorities, they just simply disregard it all and try to treat it as a service and apply the high tax burden. So it's a very debatable matter in Brazil.
And also, again, kind of like one of those reasons, right? If we think about it under OECD, we might think about it as a shared service arrangement, but here we want to very specifically, right, stay away from that, right? It's a cost sharing. It's not.
We cannot say the word service. When you say the word service in any agreement whatsoever, tax authorities stick to that and try imposing the high tax burden.
Exactly.
And here it's important what it was talking in the other part of the legislation, because now the regulation has an article with the design of a control transaction, realistic options. So all those are tools that can be used in some way to try to, if the case it is, to recharacterize the transaction as a service. And you have to document that in your transfer pricing study. So when you go into that cost sharing, you have to be very careful to analyze it on how you want to document it, or potentially to see a different alternative to the cost of that. Because now, because of the arm's length principle, you can go and try to put that into the product itself and not necessarily a service, because now the pricing of that product can support that because of your transfer pricing arm's length principle. You can get into that. So it's very important to see this supply chain on the services and how potentially another transaction can incorporate that type of expense.
Perfect. Hey, look, with some of the last moments here, let's look at a more detailed little case example. So we can just advance that slide here to the next set. And what we're trying to look at here is just the very common model, right? Taking the most typical sort of approach that I think we would generally think about from a global transfer pricing view, right? Have a global principal, whether that's a parent company or another maybe IP type company or something, but a principal company, and then operating with a set of more or less limited risk distributors. Not wanting to get into all the technicalities of exactly what an LRD is or how that specifies, but just for simplicity's sake, right, a limited risk model here. And really what we're talking about is putting it into a position where we can have that Brazilian distributor having a targeted margin, right, and supporting it and justifying this kind of an approach versus the historic policies around pricing and having to pick your specific pricing approach. And maybe we can go through, Kevin, just to the next one here. And Andre, we'd love sort of just to kind of get your thoughts here, right? A little bit more on how these models can really operate under the Brazilian legislation now, because there's still going to be some unique elements as well, right? In Brazil.
Yeah, you're absolutely right, Mark. Again, transfer pricing is no longer a pure tax matter, but it will affect your entire supply chain and local and cross-border transactions. Brazil has a very high set of VAT taxes and other taxes that apply both on imports and local transactions. So when reshaping the operational model to adapt to new transfer pricing rules, taxpayers also need to pay attention to this side effect, which will impact the local transactions and import transactions. Because again, Brazil has 6 or 7 other taxes that apply on transactions involving goods and services, and that all will be affected by this new set of transfer pricing rules, and also by the other tax reforms that I mentioned early in my speech, that the government has already submitted to the National Congress for approval, or that they are drafting right now. So it's also important to bear in mind that this is no longer a pure transfer pricing compliance matter as it used to be, but it's a much more complex and in-depth analysis regarding your operation, your economic matters, and all the other tax aspects related to your supply chain.
And also knowing that the regulations in the past were on fixed margins, in which you have to have a specific margin from a gross perspective, a gross margin formalistic approach. Now, a lot of companies, because having that limitation, they couldn't apply a limited risk distributors because they could not apply to that 3-5% operating margin that you were expecting, because they were in somehow rejected because they have to apply this formalistic approach. Now they have the opportunity to adapt those transactions that in past should have been a limited risk distributor to really actually be a limited risk distributor for that purpose. So there's a lot of operational changes and an exercise on the supply chain in order to correctly adapt that to the possibility on that. And you have to have your intercompany agreements. You have to act as you are a limited risk distributor, and those are changes that have to be implemented. So usually we see this as an opportunity for the companies to implement that, but also to know that there has to be operational changes that have to put in place. And usually we see it as a mini supply chain project in which the companies have the ability to be aligned to their global policy.
You know, and Andre, but I'm also just kind of thinking about these setups, right? Because of course, you know, maybe we're thinking about it a little bit from a U.S. headquarters standpoint and a subsidiary going down, right? And some of the advantages there of making Brazil kind of on a common platform, if you will. But, you know, a lot of companies also use Brazil, say, as a regional hub. And, you know, might have Brazil where we've got some kind of manufacturing or some kind of other sourcing, but then actually working out towards, you know, other countries in Latin America. So, you know, these changes will also be important, I think, right? Well, not I think, they will be important, sort of from a local Brazilian standpoint, and thinking about those kinds of structures as well, right? And pushing services or goods out of Brazil into other parts of Latin America, say.
Yeah, that will be definitely an important factor to bear in mind, Mark. Historically, because of our high CIT rate in Brazil has 34%, and there are bunches of other taxes on top of gross revenue and so on, multinationals have always tried to extract as much profit as possible from Brazil. And now, depending on the characteristics of the Brazilian operation, tax authorities may have a window of opportunity to chase this type of transaction, this type of structure, and try to get a higher piece of taxation here on top of the profits. So it's important to take a look at neighbor countries in South America and occasionally try transferring operations to other countries if we envisage, after the TP assessment that Antonio mentioned, that the impact of new TP rules will be too high in Brazil.
And that's where really, right, it's not too late yet is kind of really the bottom line, even though, you know, I know we have the September deadline for 23, right, and maybe kind of realistically for a lot of companies, if you haven't thought about it yet, right, 23 is probably pushing it for a lot of reasons we were talking about. You have to make a lot of changes to do this properly. Doesn't mean it can't be done, but it would be difficult, I think, to really implement it for 23, perhaps. But you know, but ultimately, it's about doing that assessment right now, right? Kind of really understanding, getting it put in place the right way, and looking to do that really before the end of the year, so that going into 24, that you've got that system set up for the fiscal 24 period, and sort of not still behind the game, right? And thinking about it, you don't want to wait 12 months and kind of say, hey, oh, geez, right now I have to do this for 24. What am I going to do, right? How am I going to make this happen retroactively? You want to sort of be in there now, making these assessments, right, and establishing good policies.
Absolutely, and just as a benchmark, very few companies have elected to anticipate the effects of new rules, but many of them are preparing themselves and running a TP assessment to anticipate the effects of new rules that will come in force as from 2024.
And that's definitely in line with a lot of the participants on this webinar based off of the answers they've given. The key takeaways from what I've heard is, changes are coming, right? We need to start thinking about it now. And, this is one of those things you don't want to play catch up on. And so really start thinking ahead and making sure that, your I's are dotted, your T's are crossed, because especially when you're thinking of what are the auditors are going to do in a jurisdiction that always wants to have more revenue, and then you're saying what are the financial statement auditors going to say when it's a new regime and you might have differing views. And then you also have to think about what are your competitors are going to do, and how do you ultimately set up your operations, in the sense of, does this potentially expand or shrink your operations in a particular jurisdiction? What do you want to do? What is that other jurisdiction based off of your global platform? What is their transfer pricing regime, and how does that interact? Just because Brazil has changed its rules, it doesn't mean that the other countries have as well. And so you really have to take, transfer pricing as a holistic view. It's not just a one-sided, especially when it's, internally. And so it's good for one versus the other. But, Antonio, Andre, Mark, thanks so much for joining us. It was definitely informative. Kevin, it would be great if you show us, Answer Connect and what they might be saying when the regulations ultimately come out, and then also just what other tools we should know about. So thanks again, guys, for joining us. And Kevin, please feel free to take it away, and I can see your screen.
Excellent. Gentlemen, thank you. That was phenomenal. Great deal of information, a lot of opportunity out there as we get more guidance as it comes down through the Brazilian regulations. What I want to do in the next couple of minutes here is just take a look at the Tax Research Solution, CCH Answer Connect. Before I jump into that, though, I think one of the things I wanted to mention is what we did as we launched CCH Answer Connect a few years back was we really wanted to take a look at the research processes by which you go through and how you accumulate information, how many steps you had to use and to do within a search tool to pull all the relevant information together on a given topic. And as we looked at building CCH Answer Connect, we wanted to address those specific issues for you. And as we go through and take a look at some of this information regarding transfer pricing in Brazil, hopefully you'll get a feel for what we've done with CCH Answer Connect. We'd love to have the opportunity to speak with you further about it as well, if you are interested. So what I'm going to do real quickly here is just run a quick search for Brazil and transfer pricing to tie into the discussions that we've been having today. And what you'll notice here, I've gone over to my international tab. We do break it out by federal, state, or international. I'm actually going to jump down directly into what we entitled a topic page. And what we've done with this type of format is actually given the researcher from this standpoint the overview of the Brazilian transfer pricing scheme, what it looks like, how it feels, and all the information related to that. So as we scroll down, you can see here we've got the additional information. We're talking about many of these new developments that we've heard about today. We are covering these at a very high level. We know that the adoption of the OECD information is available today, but as we've also heard, we're waiting for the Brazilian regulations to be released with specific guidance in terms of how Brazil will handle this piece of information. So again, we've got all that information regarding the upcoming changes. But as I mentioned earlier, one of the things that we tried to do is bring in additional content for you. So as a researcher, you're not leaving one page going back to search results and trying to locate additional content that will be on point for what you're looking to do the research on. So we've gone down into our recommended topics here. So under your transfer pricing general rules, we're going to cover the general principles, the allowable transfer pricing methods, transfer pricing transaction types. Again, all information that you will likely have to review as you go through the process of understanding exactly how to implement these new laws issued by Brazil and the regulations that are to come. So again, you've not left this page. All the information is here for you. We've also then brought directly for you the key primary source. So in this case, I'm going to go ahead and open up our smart chart for our global laws, and we're going to jump directly into Brazil. And now this is again where CCH Answer Connect has put together all of your laws for your tax, commercial, so on and so forth, with links to the original language documented as well as the translated documents. So again, very efficient in terms of you being able to pull that information without having to go seek it elsewhere within the research platform. I'm also then going to bring in the smart chart technology. What type of information can we give you in a smart chart format regarding this specific topic? So for here, I'm simply just going to open up our transfer pricing node, and I'm going to open up a few of these as we take a look here. But this again is where you can go in and get some of the laws and regulations. What are some of the transfer pricing methods that are allowable? And you can see all the different types of information that are here. We then allow you to go in and select your countries. Currently, CCH Answer Connect, we are covering 125 different countries as it relates to this type of information. So as we take a look really quickly at Brazil, this is where we have the discussion. I can expand all of these out for you if you want to take a really quick glance at it. But again, we're going to give you that information. We're going to give you the citations. If there's additional country analysis links that we want to take you to, we've made those available here as well as part of the overall research process. We've also then brought in any news. We do push news out to you on a daily basis from an international standpoint, but we do also aggregate it here in the topic pages. So as you can see, June 20th is where they talk about the Brazil enacting the new transfer pricing laws. We've talked about the update in terms of the extending the consultations on the regulations for transfer pricing. Again, all of that information is brought to you in a single location. If you do need to jump into other jurisdictions, just out of curiosity for transfer pricing information, you have that ability here as well. So I'm going to go back really quickly, if I could, to the search results. I want to show one other feature that's available. We do have journals out there where we cover a great deal of information on all aspects of international taxation. What I actually want to focus on here specifically is where we went in and we prepared an entire journal article, similar to the discussion you've heard today, where our editorial team has gone in and taken a deeper dive into this specific topic and its implications. And again, the editorial team has done a great job of putting that together in terms of where the actual policy sits at this point. Going to go ahead and jump back to our search results. So that at a very high level is the content relating this specific issue of transfer pricing. I'm going to go back to my home page really quickly just to open up our international tax topics to show you another entry method to get to this information. Going into the categories. Again, as mentioned, we cover 125 different countries. So the layout of the content specifically is laid out identical from country to country. You can see all of the different topics that are available. From business formations, capital income tax. I'm going to scroll down a little bit quickly here and get down into that transfer pricing area. And again, we saw a lot of this from the standpoint of Brazil, but if you do need to take a look at that overview for a specific country outside of Brazil, you have the ability to jump into any of the countries here from the auto link list. So again, would love the opportunity to discuss our international content with you further. With that, I will pass it back to Margaret for our final polling question.
Thank you, Kevin. That wraps up today's webinar. We want to thank everyone for their participation. As a reminder, CPE credit will be posted within 2 to 4 business days. You will receive an email with a link to the course evaluation and your certificate of completion. Today's webinar was also recorded, so you will receive an email with access to the link within 24 hours. Thank you for attending and have a great day.